Hello, Scott Roberts here with Nichols Wealth Partners to talk to you a little bit about permanent life insurance. I get asked a lot of questions about permanent life insurance and what are the differences, and some people think that all permanent life insurance is whole life insurance, and that's not the case. So I wanted to take a few minutes today to talk about it in very general terms, and I stress general terms because each insurance company, they come out with different riders and features where they can have a certain type of product act a little bit differently than their competitors. So again, just to talk in very general terms today. And I think the best way to do it is to kind of go through the evolution of life insurance. And to do that, we'll start with term life insurance. So, it used to be the only kind of insurance you can get, and it's pretty simple to understand. You're just paying a premium each year for a set amount of death benefit. It's usually a level death benefit. The premium's usually level, and it can be level for a certain period of years, and then it jumps up. But everybody kind of understands term insurance. It's pretty simple. It has great utility when you're talking about family security, and then it also gets used a lot in buy-sell situations, buy-sell agreements for companies. But what happened is that after a while, people realized they wanted some coverage that would cover their whole life, and so that's where actually the name whole life comes from. And so whole life insurance, you basically have a permanent coverage with a fixed, not a flexible, level premium, and you've got there are some guarantees built into it. And the cash value inside the policy is invested in the general account of the insurance company, which is typically invested in interest rate sensitive investments like bonds. So it's really a product that's going to be driven by interest rates. It often has some higher premiums than other types of permanent insurance as well. So what happened though is that after a while, people realize, wow, whole life insurance is great, but we want to have a little bit more flexibility. I want to be able to pay more in or pay less in. And also, if I can have lower premiums, how do I go about doing that? So insurance companies responded and they came out with traditional universal life insurance. And in some respects, it's the same as whole life. For example, it's permanent coverage, but it does have flexible premiums. So as long as there's enough cash value inside the policy, you could skip a premium or pay less. It gives you that flexibility. The cash value, the same as whole life, it's invested in the general account of the insurance company, which again is in interest rate sensitive investments, typically, like bonds, that type of thing. So now you have people with universal life insurance, and interest rates are back when they're say 8-9%, but think about the early 90s, stock market is just killing it. So everybody is a genius investor, and they're thinking, well, wait a minute, I can get 25% in my portfolio, but I'm only getting 8% in my life insurance. So, what can we do about that? So insurance companies were quick to respond, and they came out with something called variable universal life insurance. And in some ways, it's the same as traditional universal life. You've got permanent coverage with a flexible premium. The difference being is that the policy owner is going to direct how the cash value is invested in available sub-accounts. And those sub-accounts are similar to mutual funds. And the policy owner, though, is obviously going to assume the equity market risk, and you could have rates go way up, the returns go way up, so you could have a huge positive return, but you could also have a negative return. And so for a while there, this was working out great. Everybody liked it. But then if you think about what happened in 2000, 2001, stock market crashes, all of a sudden these types of products are very much underperforming, and people are clamoring for some type of guarantees again. They didn't want to take that risk. And so again, insurance companies, ever wanting to please their customers, come out with guaranteed universal life. And it's a little bit different. It is permanent coverage, but it's got a guaranteed premium and a guaranteed death benefit. So a little bit like whole life in that respect, but typically having lower premiums. And so the insurance company is going to basically guarantee the premium. So if the insurance company goes out of business, then that's a little bit different, but that's probably a subject for a whole other story, is what happens when insurance companies go out of business. The short answer is other insurance companies buy up all the policies. So you typically don't have to worry about not getting paid on the death benefit. Guaranteed universal life usually has much less and oftentimes no cash value inside the policy. So it's not really designed to build cash value. It's kind of like having term for life. Now, the fact that there's no cash value inside the policy means that if years later you wanted to replace that policy with a different policy, it's a little bit harder because you don't have really any cash to roll over into the new policy. So now we have guaranteed universal life, and then after a while, I would say the pendulum kind of swung to the middle, and insurance companies still wanting to be able to offer market rate returns or equity market returns came out with something called indexed universal life. And with indexed universal life, again, you've got permanent coverage with a flexible premium, but it's a little bit different because the client is going to select from one or more underlying index options, and the insurance company is going to credit the cash value based on the return of those indexes. For example, like the S&P 500. These days, though, index universal life is becoming more and more popular, and so the insurance companies are coming out with or partnering with people who have proprietary indexes where they try to manage the volatility, because you don't necessarily need to hit a 20% return for it to work really well. You just want to avoid negative returns. So that's something that's happened a lot more in the industry. Typically, let's say you're in the S&P 500 inside an index universal life, and the S&P 500, goes up 20%. They're typically going to cap it. Right now, caps are around, say, 10, 11, 12%. So anything above that, you're not going to get. You're only going to get the 10 or 11. The positive, though, is that if the market goes negative, you're not going to have a negative return. All these products have a floor. It's usually 0%. Sometimes it could be 1%. But basically what that means is that market goes negative, you just get a zero that year. So over time, there have been some evidence showing that just having positive returns over a period of time with no negatives, you end up farther ahead in the long run. So that's kind of how index universal life works. So that's kind of a summary of the main types of permanent life insurance. Again, this was just designed to give you a sort of high level, the main differences between them. Some of them work better in some situations than others. For example, guaranteed universal life usually skews toward older insureds because they're probably not going to make too many more changes to their life insurance. Whereas if you're younger and if you get into a guaranteed universal life policy, you're kind of stuck with that for a long period of time. That's one thing to keep in mind. And then if you're looking to build cash inside the policy in addition to the death benefit protection, then you're probably going to be looking either at a whole life if you want more of a conservative type way of doing it, or an index universal life if you want the possibility of some market rate returns. But then again, still having that floor as kind of training wheels. So anyway, that's a brief overview. If you have any questions, please feel free to call or to email. And thanks for your time today.